Hi, my name is Leon Rowe, currency trader and trading coach at trading180.com, and welcome to this video on how to identify profit targets using supply and demand. And before I get started on this video, just wanted to wish you all a happy new year and hope you had a good one. Hope you all stayed safe, with family, friends, and had a nice, enjoyable one. And now it's back to the business, back to trading, and hopefully we can have a profitable year, right? And so we are on the pound dollar on the daily, right? And before we really get into this trade, I just wanted to flash back to this video that I did a couple of weeks ago, 2 weeks ago. And on this video, I was talking about why you should use why basically the support and resistance isn't always the best area to buy, right? Not always the best area to buy, and supply and demand, is really where you should be looking at, because it's identifies value, etc., right? And we can see that if you did enter on any of these pullbacks, pin bar candles, to what would be resistance, obviously it didn't work out, probably would have got stopped out, and really this is where the move was. And if you managed to get in, I didn't get in, right? On this one, wasn't around, but this is just an example of if you did, well done as well. But this is where the best place to really enter on a trade would have been. Yes, this could have obviously failed as well, but I did give you guys the heads up, and hopefully some of you might have taken advantage. But the trigger, and the trigger that I saw anyway on the 1 hour, I definitely wasn't around for that. But we'll go over the trade anyway. And in fact, I'll go over another trade that I did get in, and using my basically the profit targets as well. So basically prices coming up into this supply zone, and then you're waiting for any kind of trigger. Entry candle, one of my favorites is the outside candle. It's a nice one on the hourly, and that was the 31st of December at 3 o'clock or 4 o'clock close. Yeah, if you did manage to get in and you were around the charts at that time, brilliant. If not, there's going to be plenty of other trades. But going back to the daily time frame chart. Now, my plan was to obviously trade and look for an entry around here. And had I seen one, I would have obviously entered. Now, a lot of this video was kind of created due to a comment on YouTube, and someone asked about me, where do I tend to take profit? So I thought I'd make a video on this. And what I do, and what you can do, right, is I look for two targets, right? One of two targets. Now, what I'll do is I'll use the Fibonacci tool, and I'll go from the low to the high. And the eagle eye amongst you will see, certain labels, and one of the labels is called targets. And targets, and what I normally go for is either 50%, right, which is fair value, or I will go for the 88.6 around here, which is the low of a potential range, because I'm always expecting prices to retest the low at least, right, or at least fair value, I should say, right? At an absolute minimum, prices should retest fair value. And if I, my bias is obviously to buy the dollar over the British pound, I should be expecting prices, trade it to really the low of the range, right? Not the absolute low. And there's a reason for that, which I'll get into in a bit, but I want to be trading it to the low. So these are the two targets that I'm looking to enter. And if you want to obviously know how I do it, just double click on the Fibonacci tool, take off everything else, and then leave the 50.5%, and then you've got the 0.886, right? And then what you're doing is you're looking for a low to a high, right? If you're looking to trade back down to the low, because it's more of a retracement you're looking for. Because if I'm getting in here, then first target is here, second target is here. Now, in this example, I would have been looking to trade the lows of the range, simply because depending on obviously the entry, what I want to do is I want to go for at least 2 to 1 on one of my positions. I split up my positions into two. One is going to go for a 1 to 1, and the other is going to go for the home run, if you want to call it the home run, or it's going to go for where the money is really made. So first one goes for a 1 to 1. Second one I'm looking at is going for at least a 2.69 or to the 88.6. And the reason why I do that is because I have a decent, quite a high win rate, or above 50% win rate for 1 to 1s. So that keeps my account ticking over, and then pretty much the bonus is the second one. And if I lose the second position, once I've made my 1 to 1, then it's pretty much just a break-even trade. I can always re-enter, etc., or I can choose to move my stop, down to half, or break even on that one, so that if the second position does run and then manages to come back up, I've still made some money. But it's just basically just a risk management thing that can be is optional, right? So in this situation, if I was going to enter on the hourly, 1 to 1 is the first position. The second position for me, you must go for more than a 2 to 1, right? And the 50% fair value between this low and this high doesn't represent a 1 to 1. I'm sorry, a 2 to 1. So I'm normally going to go then for this profit target right here. And why the 88.6? It's not because it's a magical number or anything like that. It's just I remember using it when I first started trading Fibonacci's, and it represents as well from a more of a trading psychology perspective. You're trying to get out before what is termed as a crowded exit, right? And I say crowded exit. If you're obviously we're selling up here, right? Where is demand going to come into the market, right? If you didn't take profit here at this area here, right, the next best area to take profit is going to be around the lows. Now, what you don't want to do is be left holding the bag. Sometimes due to this, obviously last night, this bit of a flash crash that happened in the Forex market, but generally what you don't want to be doing is left holding the bag. So you don't want to try and trade it all the way to the lows, because prices might not make the low. And what happens is as prices start to come down, right, as we're getting lower and lower towards the lows of the range, everyone's looking at this low of the range as an area to potentially take profit. So what happens is that there's going to be traders exiting, right? If you've got in up here, or if you've got in anywhere around here, you're going to take profit at the lows of the market. Now, if everyone's thinking the same thing, that's why it's called a crowded exit, right? And you don't want to be left holding the bag, in the sense that you don't want to be the one who's the last to exit, because prices might not make it down towards the absolute lows. So I like to take profit just before everyone else is, or around the time when everyone else is probably considering taking profit, and that 88.6 represents a nice area to try and take profit. Will I always take profit at the 88.6? Not always, depending on whether it's before or after a round number, right? So you had the 125 round number, which a lot of people probably would have been aiming for, just beforehand, a few pips, before that. But 88.6 obviously was 15 pips above that, so that was a good area. But let's say, for example, the 88.6 was below a round number, and the round number will say somewhere up here. Would it make sense? And a lot of people tend to take profit at round numbers as well. So maybe, depending on my risk reward, if it represents more than a 2 to 1 and I've got a round number just above the 88.6, I might take it at just before the round number as well. But I'm trying to take profit overall just before everyone else starts to take profit, because what you'll notice sometimes is that the market doesn't always reach the lows, and I want to try and take profit and get out around the lows. So if you are struggling to take profit, right, at areas where you've got, you don't know where to take profit, basically, these are the two areas that you should look to take profit. Also, what's going on from a supply and demand order, perspective as well. Not only do you have the crowded exit and traders looking to exit their trades, which is if you're selling up here, right, you've got to exit, you have to press buy, right? So demand is coming into the market. And what other traders do you think are getting in? Traders who are trading the lows of areas, and if this was a level of support in the past, then traders will be looking to enter new trades, which is buying. If you're buying the British pound US dollar, that's going to be more demand. So net you have to ask yourself, why is there going to be supply in this area? There should be take profit orders, which is demand, new buy orders, which is also demand coming into this area. So to really try to think that you're going to I'm not saying that prices can't end up going lower. Obviously they did here, but the smart move would be to take profit around here, maybe look for obviously a pullback into some sort of supply zone before looking to re-enter, right? And if you go through, and I'll zoom out and go through maybe some different examples as well. If you're looking at, for example, this area right here, so this would have been an area of supply. Let's change this to supply. Right, you've also got another area of supply here, and these are actual trades that were taken. Right, you can look back on my weekly videos and identified. Right, now let's say for example you got in here, right, trade didn't work out, fine. If you got in here, somewhere around here, if you saw your entry, fine, didn't work out. But if you got in around here, now you have a great risk reward going on. And what you want to do is you want to trade, again, depending on if you're entering on the daily or intraday. I normally enter on the intraday, 4, 6, 8, 12 hours charts. I see the trigger, right? And then what you would be doing is looking at entries around here, and assuming that this is going to be the high, you're trading it down to either fair value or the lows, which represents 3, 4, 5, sometimes 5 to 1s. And yeah, so let me show you another trade that I actually did take, which was the Aussie CAD, and I was in this from last year, and it actually reached my profit target, which was 50%. And it was from this supply zone around here, and really the catalyst for it was the Australian GDP figures, which came out, and they were way below expectations. And I happened to be awake when this actually happened. I think it was at 1 in the morning. So as prices came up here, waiting for GDP to come out, I think the expectation was at for 0.6%. It ended up coming out at 0.3%. This being my entry candle, nice outside candle there. I say a nice one, but it was an outside candle. I prefer my outside candles to close at the low, but it was an outside candle nevertheless. Stop above the high. Some people will do market highs. I will, with outside candles, I tend to just do maybe above the actual swing high. And again, 2 targets, right? One being here, or one being right at the actual lows. Let me just auto. So this is what it would have looked like. Now for me, fair value is a decent 5.89 to 1 trade, and luckily obviously the spike helped that happen last night, which was a good trade. But it just goes to show you that you don't always have to aim for the absolute lows, and that 50% from this daily low this ultimate low to the highs around here can also represent good risk reward as well. Another reason why I chose fair value was maybe for, I say maybe, but it was for fundamental reasons. The Australian and the CAD were pretty much in the same boat when it comes to fundamental analysis. One isn't particularly much stronger than the other, even though the Australian dollar is probably a bit weaker than the Canadian dollar, which is definitely the reason why I took it. But I wasn't expecting prices to really come all the way down here anytime soon. So you know, fair value, which prices have, you know, obviously been rejected off of, was the smart play. So whenever you're looking at you know, trades, right, look at fair value profit targets, or trading them at to the lows of the range if you believe in you know, the pair that you're buying to be the stronger currency. Going back to the pound dollar, right, you'll also see that, you know, traders who just trade technicals will look at this as being in a trending market, right? You know, we're making lower highs, lower lows, etc. We had a bit of a pause here, ranging market, and then the trend continued. So if you're looking at trend continuation, right, if you were looking at trend continuation, then, you know, you would have got a pullback into that supply zone, and then again you trade it down to the lows where your take profit would have been around here, and taking profit around here would have been the smarter play, rather than expecting prices to really kind of, you know, push through and continue going, even though a lot of times, but you know, sometimes it does, sometimes it doesn't. But you want to take profit along the way, right, when you're trading. So if you do have any questions, you can email me, leave a comment in the section, you know, box below, and I'll endeavor to get back to you as soon as possible. Hopefully you know, this helps you guys in, you know, determining where to take profit. The main thing as well is obviously if you want to, you know, back test this, or in you know, this, I won't say it's a strategy, just take profit in a you know, in a ranging or trending market, be my guest. You'll see that 50% and the 88.6 tends to you know, get hit more often than not. And again, you have to apply, you know, fundamentals, etc., right, to, well, I do anyway, when I'm applying my back testing on if I really would have been buying the British pound or buying the US dollar. But anyways, hopefully that helps, and again, if you have any questions, let me know and I'll get back to you as soon as possible. And take care.